But that brings us back to the question, why do these CME gaps get filled, especially since the CME is such a small slice of the crypto derivatives market? And the short answer is because of institutional investors. And this requires a bit of explaining, so bear with me. In TradFi investing, there's a popular trade called the basis trade, wherein institutions will hold an asset and then short the same amount of that asset. When it comes to crypto, a popular basis trade among institutional investors is to buy Bitcoin using the spot Bitcoin ETFs and to short an equivalent amount of Bitcoin on the CME. If Bitcoin's price goes down, the value of their spot Bitcoin ETF holdings also goes down, but the value of the Bitcoin short on the CME goes up, and vice versa. If Bitcoin's price goes up, the value of the spot Bitcoin ETF goes up, but the Bitcoin short goes down. And this method makes it possible for institutional investors to make money from fees and price discrepancies between the spot price of Bitcoin and the futures price of Bitcoin on the CME, without the risk of losing money when Bitcoin's price pumps or dumps. The caveat, though, is that sometimes the price of Bitcoin on the CME will deviate significantly from the spot price, like when the CME is closed. The outcome is that institutional investors, including hedge funds, arbitrage traders, commodity trading advisors, and others, will buy and sell Bitcoin on the spot market and the futures market to, close the gap between the spot price and the futures price for their basis trade to work. There's also the self-fulfilling prophecy aspect, where investors will just buy or sell Bitcoin anticipating the CME gap will fill. In other words, the reason why CME gaps get filled so often is because of institutional trading strategies that require those investors to buy or sell Bitcoin on the spot market to bring its spot price back in line with its previous futures price. Of course, it's a bit more complicated than that, but that's the basic explanation. This is fascinating because it effectively implies that crypto spot markets aren't nearly as liquid as advertised. And FYI, many people in crypto claim that Bitcoin is the most liquid asset in the world, presumably because it trades a lot and trades against many different currencies. The thing is that lots of trading volume doesn't always equal lots of liquidity. Market depth matters a lot too. In plain English, an asset is liquid when investors can buy and sell large amounts of it without moving the price. As we've seen with Bitcoin and other cryptos, all it takes is a few $100 million of long liquidations or short squeezes to push prices up or down by 5% or more.